In this short video, I will tell you the 7 biggest beginner mistakes you should be avoiding in trading. Without further ado, let's get started. Mistake number 1, not cutting your losses quickly enough. Alright, you take a trade, it goes in the wrong direction. What do? You're in loss, you're in negative profit. Obviously you don't sell. You keep waiting, hoping that the price will go up. What happens? The price keeps going down and you just keep hoping and hoping until eventually you admit that you were wrong. So what you should be doing is setting a stop loss. Okay, a stop loss means a price you determine before you take the trade, at which point the trade will automatically execute so that you leave the trade. Okay, this means you know exactly how much you can lose and you don't just let it slide. Mistake number 2, and it ties into the first mistake, is to keep buying into your losing trades. Alright, the trade goes the wrong direction, the price keeps falling. What do? You try to average down the price. Okay, you do dollar cost averaging and you say, now it's a good price. It has fallen already by 10%. Let me buy a bit more. What happens? It goes further down. You're already very deep into the trade, so you buy even more. You average down, but the wrong direction. Now, this is a good way to do your trading for long-term investing when you have short-term fluctuations, but long-term you expect the price to go up. But for trading, this is not the right thing to do. Essentially, you're just pouring gasoline into the fire. Next one, and very important one, is not taking spreads into account. Now, the spread of a trade is essentially the fee or the commission you pay to the brokerage, okay, the company which allows you to do the trading. And let's take, for example, Forex. I will blend in a picture here of 2 scenarios. It might look very little and the spread difference might be very insignificant, but over the long run, the commission you pay is very significant. Okay? So now I will blend in a picture of the best brokers you can use with the lowest spreads, and keep this in mind because long term it will cut into your profits. Okay, next very big mistake that beginner traders do is going all in. Now, they see on YouTube or on the web a big trader making $30,000 profit per trade and they think they can do the same. Now, what they don't remember or what they forget is that these big traders have account values upwards of $500,000. So $30,000 profit is not that much for them. What you now try to do as a beginner trader is going all in on every trade and risking all of your investment. However, keep this in mind. Aim for a 1 to 4% risk and amount of money and percentage of your portfolio which you are risking on each trade. Meaning, if you have a $1,000 portfolio, you're not risking more than maximum $40 if it's 4%, and you can do this by setting stop loss orders. Okay, never go all in. Another very simple one, and I say simple because that's what you should be doing when trading indicators, is not using too many indicators. At the beginning of your journey, you might think having so many different indicators, while it looks more professional, it might be overwhelming. Okay, now look at this picture. This one left trading chart might look very professional, but you might lose the overall picture. Professional traders rather keep it simple, stick to what works, and don't overcomplicate it. Number 6, only using technical analysis. That is a very big mistake. Now, while technical analysis might work in smaller time frames, you always have to keep the big picture in mind. It might seem like the perfect trade to execute, but then all of a sudden, the price dumps like nothing else, nothing you've seen ever before. And that might be because of some market news. Some central bank might have increased the interest rates and that might have had an impact on the price of the stock you're trading. So always keep in mind the general macroeconomic views as well as the technical analysis of the charts. And last but not least, it is about not looking at the right time frames. You might be on a very narrow time frame, meaning you might have a 5-minute candle bars on a weekly time frame. However, keep in mind the overall trend. So every now and then before entering a trade, look at the long-term view. All right, I recommend press the daily candlesticks and look at the last few months and see if you're genuinely in an uptrend or a downtrend. So do not trade against the trend, because once you break out, even though you might have a short-term short position, the general trend might be upwards, and if certain levels are hit, the price might shoot up and go against you. Alright guys, and that was it. Those are the 7 big beginner mistakes you can be avoiding. And if you enjoyed the video, leave a like, subscribe,